welcome to another edition of the Domus podcast. I'm Sara Speed, and I'm together with Tim Ruxton.
Hi, Sara.
So last time we had a fascinating discussion with Miriam around data and risk, and I think the conversation today is going to continue on the theme of data.
Today's guest is Nigel Batley. Nigel works for the European DataWarehouse. I only became aware of European DataWarehouse less than a year ago. And Nigel and I met recently, and I just wanted to get some more information about what they do and how they do it. And the conversation we had, I thought it'd be 5, 10, 15 minutes. We talked about 45 minutes, mostly about data, not entirely. So I wanted him to be on this podcast, and I thought he would be a fantastic person to talk about a lot of things that are going on in the marketplace. They do see it all. And Nigel's got some really good experience. He's got a background in, I believe it's in banking. And before that, he's has some other good experiences, which I'm going to make him talk about. I'm not going to give his background here because I want him to do all the talking.
Okay, so it sounds like we're going to get perhaps a slightly different perspective on the market as well, given that we're speaking a lot to GPs and LPs. But to have another market participant give us their insight, I think will be fascinating.
And they're doing some things at the European DataWarehouse, which I thought were fascinating. I didn't know the breadth of their reach, and some of their forward-thinking ideas are really going to be helpful to the marketplace. We do use some of their services through another third party we're working with, which is how I became aware of them. And some of the things that those guys do together are extremely helpful, extremely valuable, extremely validating. So I'm looking forward to having him up here and getting his perspective on some of the things we're seeing today and some of the things we've seen in the past, because the European Data Warehouse was built probably because of some of the things that happened or wasn't happening with data in the past. So a need arose. Where there's a need, someone else is going to fill it. They have filled this need, and it's going to be fascinating to get him on here. All right, as promised, here on the Domus podcast, we're joined by Nigel Batley of the European Data Warehouse. First, I want to point out that it's Batley, not Batman. I couldn't wait to talk about this. You want to show us your cufflinks? There you go. No. I love them. So thanks for joining today. I appreciate it.
Tim, it's great to be here, and thank you for the invitation. It's great to get the opportunity to talk about the European Data Warehouse and what we do, and the role we play in the marketplace in Europe and the UK.
Well, it's almost like you're leading into the next question. Let's talk about the role the European Data Warehouse plays, or actually, you know what, maybe even before that, what is the history of European Data Warehouse?
Yeah, so the European Data Warehouse was established in 2012, and that was really as a response to what was going on through 2007, 2008 with the global financial crisis. And what happened was that banks needed finance, and finance wasn't generally available because of there's a lack of confidence in the marketplace and what was going on. And so the ECB became effectively the banker of choice for banks looking to access liquidity. And the ECB, after a while, thought, it's great doing this, but we actually really need to know what the banks are funding. And so in 2012, they established European Data Warehouse with ownership from the market, not any individual, with the view to be able to store data so that the ECB could actually see what data and was actually supporting the loans it was providing to those banks as a central bank to the market. And so that was the ethos of the group, and it's evolved since then. ESMA took over the regulatory aspects of that and designed templates, which we still do today. And there's now an entity in the UK which does exactly the same thing and complies with all the FCA regulations as well, all to do with data. So it's reporting lines of data. Since we started, we've now got over 5 billion lines of data that relate to all the different asset classes you'd see in the securitization markets: mortgages, CLOs, auto loans, etc. Everything you can think of that's been in the marketplace, we've got data for it.
Now, your background prior to European Data, should we call it EDW or should we call it European Data Warehouse?
EDW is how we prefer to it, but anything works, right? Yeah.
Prior to EDW, you were in banking for several years.
I was, yeah.
Were you involved with the EDW then?
No, I mean, peripherally we were, and I was glad head of structured finance at HSBC at the end of my career. Obviously didn't start that way. I think I remember taking staples out of checks in January 1987, which is when I started. But eventually I sort of migrated my way through a bunch of risk and corporate banking roles and into what was then called securitization. And so that's how it came about that I became global head of that business. But we operated a conduit that was called Regency Assets Limited within HSBC, and that used EDW's services in the UK to actually host all our loan level data for the conduit. So there was an early tie-in, but I didn't really put the dots together until much later when I started looking at EDW as a prospective employer.
It's fantastic.
It's funny, isn't it? Because I spent a lot of time as a senior banker and looking at transactions that we were doing for our clients, and all of them were data-based. And when the regulations changed and all of the market was required to report loan-level data, I think most bankers and most originators at the time thought that that was an unnecessary inconvenience, having to provide these extra bits of information to support the underlying deals. And so when I first spoke to Christian at EDW about the role, I was thinking this is just a boring repository of data, a warehouse like it says. But as I started to speak to the guys within the business, it became clear to me it's not just a warehouse, it's actually a tech business or a tech-focused business. And what we actually look to do with the data that we hold for the benefit of the market is to provide a whole bunch of tools so that people can analyze that data. They can look back and recreate management reports. They can look at how those data pools perform in relation to other data pools and other things like that. And so I started to get very interested with the future direction of the business. We're also just about to launch a virtual data room, but unlike a lot of virtual data rooms, which are all things to all men, this one will be specifically focused on the ABS markets. So we'll have an ability to host data in a data room, press a button and automatically upload it in the correct format under the ESMA or the FCA templates into the marketplace. It makes everything so much easier for originators. And it's just that forward-thinking approach from EDW that I thought was a good match for me. And also, when I left HSBC, I was running a consultancy for a small period of time. One of the questions they always asked was, what data do I need to be able to provide in order to comply with the securitization regulations? Well, EDW gave them that answer. So it became a very neat annex to be able to provide those clients that I was dealing with in the consultancy with that access to the marketplace and to experts that could make sure they complied with all the criteria that they needed to.
We spoke really for the first time last week.
Yep.
And just like yourself, I thought it was a warehouse. You're just storing data. I'm trying to think, what do these guys do for a living? Are they, is there a bunch of boxes back there like Raiders of the Lost Ark style? And do you compete with anyone in the marketplace with your analytics?
Yeah, I mean, there's lots of people that do analytics. The data that we collect, we actually also provide to Moody's, who obviously use that as part of what they do. They're one of our shareholders, as are Morningstar DBRS. We also provide it to Bloomberg as well. And so those sorts of organizations use the data, and they'll obviously have their own analytics that they can provide on that data. There is a competitor, EuroABS, predominantly in the UK market, that also hosts data on securitization repository. But I don't think that they do what we do in terms of the overlay that we have for the data that we have, in terms of the ability to analyze that data, compare it. And some of the things we're now doing because of the incidents of fraud that's happened in the marketplace, First Brands in the US, and we had MFS in the UK. So those sort of issues have actually raised the spectre of now you see it, now you don't. And I think that has meant a lot of credit committees and investment committees in private credit funds and in banks are now actually thinking of fraud risk in a way in securitization transactions they never did before. So we're developing tools that actually look at the data that we hold and actually look to point out anomalies in the data that might have come through that might point an auditor at a place to look at, or even the originators to look at the information they're reporting to make sure that's actually completely accurate before it's then posted onto a public market.
So is that then a question of that the data may have been there, but that possibly what was the message within the data wasn't being seen?
Yeah, I mean, the issue that's come through in frauds, and it's all within the private markets rather than the public market. The assumption is that there's been double pledging, so the same loans have been put into multiple SPVs. And that's been something that's not very obvious to pick up. And so, if you had multiple pools that might have these loans in multiple pools, but no way of checking across, we're now developing those tools that will actually be able to check across different SPVs to make sure that there is a double check to make sure that those account numbers don't appear in more than one place. And then also to look at just how things perform. If you've got an amortizing loan, we can on a loan level basis analyze whether that amortizing loan is actually amortized and point out whether that amortization is in line with what you'd expect it to be and whether the portfolio looks like the other portfolios we have. So we're now actually going to create effectively heat maps, which will give us dots for each loan that's an anomaly that doesn't look like it quite fits. And that might be a completely legitimate reason for that. It could be that the valuation of the property doesn't fit the postcode. But those things will actually allow originators and potentially funders to look more deeply into the data to actually convince themselves that what they're funding is actually really there and is in compliance with the eligibility criteria of the fund. And they will, in most of these pools in the private markets, they tend to be revolving. Public markets tend to be a fixed pool that amortizes. Private markets tend to be pools of assets that revolve, typically warehouses. And so the information, the data is there in the client systems. The problem that you might have is the format might not be identical.
Yeah.
So what we offer within EDW is an ability to take a CSV file from a client and use an XML converter to actually store it in the XML format that's then required by the FCA, ESMA, so that you've got a common way of looking at exactly the same assets in the same way. The fields all get dropped into the right place in accordance with the templates, and it allows you to do that analysis. So I think the data's there, and most of the clients, whether they're public or private, have access to that data. Getting it into a format you can use is the artwork, and that's kind of where our special box of tricks is that technological solution, which is the CSV to XML converter.
Obviously, a lot of technology required to not only bring in this information, but to make it insightful and useful.
Yeah.
What is, tell me the tech you're using, but what are the tech tools that you bring to bear, and what do you see coming in the future?
Well, I mean, we use the XML converter is the big thing that we have. And once we've actually got that into a format, which is actually then stored within the warehouse, we're then actually just a whole bunch of analytical tools, which these days are software run. But in the future, it's not a massive step to think that AI is going to play a massive part, be able to analyze a pool of data, which is, in mortgage transactions could be thousands of lines of loan data. That AI will be able to analyze that much more quickly than I ever will be able to analyze it. And so therefore, I think that is a logical next step, is that there'll be a bunch of AI tools that can actually overlay and interrogate those databases and provide people with much more insight.
Do you foresee EDW having its own AI?
I don't think you can count it out. The things that we do now are AI close. It doesn't learn, but it actually is very in-depth in terms of the analysis that it does. There's partners that we could potentially cooperate with to provide those tools as opposed to developing themselves. But we've got a massive tech team in India that's constantly working on new initiatives. I was just talking about initiatives to actually eliminate fraud. And just before I came here, we had a session from our tech team that were actually going through how we analyze the anomalies that are in these portfolios to look for things. And those tools have been built in the last 2 weeks, and it's been scoped out. It's happening very, very quickly. And we use AI as part of that to write some of the code that sits behind.
That's fascinating. 2 weeks old is probably obsolete now, isn't it?
It's probably obsolete. It's nearly as obsolete as me, but there you go.
It's terrible. Is there risks to holding the data? How do we know the data is sound?
I mean, that's the anomalies check, right? So historically, people took it as read. You put the information into the public domain and it's in the repository, and people would take that as gospel, as a golden source. I think that now there's people will quite rightly ask questions, and particularly in the private markets. So I think being able to check those anomalies and how the data performance is incredibly important. We're also speaking to various different people in the marketplace, trustees, accountants, auditors, about what the next step could be. And that uses some of the other technology that's available in the marketplace, like, for example, open banking. So being able to look at how a transaction works, new loans that have been created, flows that go through disbursement accounts. We are constantly looking with partners to try and find solutions that can make the marketplace, or can effectively dispel some of the perceived risks that fraud might have arisen. I mean, this little sort of bunch of frauds aren't the first ones, right? You can go back to Parmalat, and that was a big fraud in the marketplace. And it was over 10 years ago now. And so those things are incredibly important to actually just dispel some of the suspicion that the market or investors might have by using those technology tools to give them something that they can actually hang the hat on, as saying, look, this data passes all these tests, it looks like it's real data. And then if you can then twin that with the ability to automatically check a new loan that's appeared in the warehouse against disbursement that's gone through a bank account, you're actually, you're 99% of the way there. When you do the same things on the collection side and you look at what's come in and what the repayments look like in the portfolio, you've gone the whole 100% of the way there. You can genuinely say there's definitely a loan, because whilst you can generate a spurious loan ID and you can generate spurious loan performance, very hard to generate spurious cash. But the thing that we do quite a lot is actually generate pools of pro forma data. So if you're a new entrant into the marketplace, you're a fintech, and you've got a great operating system, it's super slick, but what you haven't got is any history. So what we're able to do for people is provide them with a pro forma set of data that looks exactly like the regions they're going to operate in, the country they're going to operate in, the borrowers they're going to lend to, if it's a mortgage portfolio, the houses they're going to buy, what LTVs they're going to target. And we can provide a bunch of information that looks like that allows them to go and get a rating or get lines of credit from banks because they can predict in advance what's going to happen. So we do that already, and we'll continue to do that as it goes on. And with 5 billion lines of data, we've got a bit to shoot at.
How far back does your history go with data?
Well, it's 2012.
We had a previous conversation about some of the things that are going on prior to 2012. And I remember looking up some of the homes and the portfolios of mortgages, and they were just holes in the ground, according to Google Earth.
Yep.
And the last photo was taken, a week ago. And yeah, I don't know if that information made it.
Well, we all watched The Big Short on telly, right?
Yeah.
And that was innovative on the basis that I remember being at the conference in Vegas at the time
That's
that
right.
was actually shot at, although that was in the Venetian, not in Caesar's Palace, which is where the film was based. But at the time, I was at HSBC, I was running the conduit business, and I was in Disneyland in a little house in Kissimmee, sort of minding my own business on the 5th of August. And I got a phone call from the office to say, we can't place CP. I went, well, add a basis point. And apparently we're already at 20 over LIBOR and nothing was happening. And that's the start for us, was actually, whereas most people think about the GFC being 2008 with Lehman failing, etc. For us, it started in the CP markets. It started in August 2007.
So I was working for LaSalle Bank at the time. I was on the first floor, called down to the branch bank. They had a retail branch, talked to some 23-year-old banker, asked him if we could place some money in a certificate of deposit. He said, how much? I said, about 100 million. That's the last I heard from him.
Yeah,
They hung up on us.
Well, I was at HSBC at the time, and we were a highly rated bank that was not suffering from the same contagion that some of the US banks got from the subprime mortgages. And I think HSBC at the time was an embarrassment of riches, a lot of incoming funds. And, one of the biggest problems that our treasury folks had was what to do with the money every day. It was very interesting times. Glad to have survived it.
Yeah, that was actually a resume builder. You survived.
Yeah,
Credit
I think
crush.
anybody that was in those markets that survived went on to have a long career, because we have long memories, right? And so nobody wants to do the same thing wrong again.
So would we consider that we wouldn't see a crisis like that again? Or is there still a risk of being complacent?
I don't think we'll see a crisis like that again. I mean, there's a lot of features that came together which just won't be repeated again. I mean, within the CDO space, so, a lot of the CDOs were buying triple B and double B RMBS. And when you consolidate it together across the US, it wasn't actually the analysis that was run that said part of it's triple A, part of it's double B, part of it's single B, just didn't work. It was just a big tranche of double B or triple B, because everybody had the same FICO scores, everybody had the same distributions, very, very similar. So I think those kind of systemic issues in the ABS markets just aren't there. But what you do have is there's always something, right? And at the moment, the private credit market has grown so quickly. It's 10 times bigger than it was, a few years ago. And I think that private credit market has happened because there's a lot of people looking to put money to work. And so those private credit markets are driven by a demand to invest, not a demand to raise. And I think that in itself creates a problem. So that maybe some of the issues that we've got in the marketplace at the moment are because due diligence has taken a back seat to the need to get money out to work. And, the number of frauds is still minuscule in relation to the size of the marketplace. The market is massive. It's very robust and performs really well, but it does create a worry, and that worry creates contagion risk. And so that's the problem. But do I think that will lead to a major problem in the marketplace? I personally don't. But I do think that it will cause a lot of people to pause and think about how they write business going forward. And I suspect that due diligence is going to become a much more important issue than it was 12 months ago.
I worry that the further we get away from 2007, 2008, the closer we get to 2005, 2006. Meaning, I talk to people in the industry now who weren't there. Don't remember. Not that we're trying to date ourselves here. I know there's managers out there that didn't know their money could earn interest overnight and over the weekend, because they just never grew up in an environment where there was, that kind of float. So I'm concerned that, this could repeat itself.
Our supervisory board's focus is definitely on us providing services to the marketplace to help protect the marketplace from these sorts of things. So that's the drive of the business. It's not motivated by, profitability or driving revenue. It's the supervisor was very, very clear that what we're supposed to do is make the market better and help the market become more efficient.
So obviously the E stands for European. What about the cowboys in the West? Why haven't the United States come up with something to parallel this, to mirror this? Or are you thinking of maybe this is something EDW become EADW?
The reason why we exist is because there was a regulation that required us to exist and required people to populate the repositories. If you don't have that type of move in the US or something else that drives that type of behavior, you just don't get the scale in order for you to be able to do that. But the facility is there for banks in the States, but it's got to be led by a demand. One of the large banks or one of the credit funds in the States has got to say something like, we're going to invest in this asset class, but we want this type of visibility. And at that point in time, then, we're obviously a business that we're very interested in talking to people. We are talking to people already, like people like Thomas, as you mentioned, and about, the services that we provide. And we'd be ready to jump at that opportunity to host data for US clients in the States. We already host data for US clients where they've got European assets.
I was just going to ask you if you're getting any kind of cross-pollination because of the regulation that's reached over the Atlantic Ocean.
Absolutely. And most of those US houses are what we call Article 17 investors. So it means they're authorized to access the data in the warehouse free of charge. A lot of them are our clients already on the receiving side rather than the providing side. But, we would be ideally placed to actually pick that up as a business. And, we went to the conference in Las Vegas for the first time this year. And, we had a lot of really good conversations, and a lot of stuff that's coming out of that conference as well was all about how do you use data to effectively mitigate fraud risk in transactions. And they then went onto blockchain and everything that came afterwards, which I mean, I was a banker, not a technology expert. So at some point in time, my eyes started to glaze over, but I nodded politely at the right places.
I want to talk a little bit about your conversations in Las Vegas around fraud.
Mhm. I think people want to know what they've got, but also, what are we going to do next? As a bank, you have the most power when you've got the capital and you're looking to give it to somebody. So I think they will be the people that are actually saying, look, we want to do this for you guys. And one of my clients recently said to me, when you've got nothing to hide, transparency is your best friend. And so these people that are looking to tap into that marketplace will definitely be happy to provide their data to credit funds and to banks in order to source the funding that they need to grow. And I think it's just an acceptance now that this is part of the world in which we operate. And if you've got great data and you've got a good business and your data is robust, that is a massive advantage for you as an originator. And the banks are going to suck that up, and all the other investors as well, because it's going to help them make sure that they're actually backing the right horse.
Is the idea around everybody will have the same data, the same clean data? Because it used to be, I remember we had clients that said, no, you can't use our data for, you want to make your own index, you want to do some research, you can use anybody's data but ours.
If you're putting data into a repository, it's effectively available to the financial markets. In terms of a common format, in Europe, it helped that the regulators came up with a template, which every now and then they tweak in terms of what they want to see. But I think it'd be much more powerful if some of the investors actually thought about what was important to them, and they suggested templates. When we can accommodate them as a business, but it needs to be something that's suggested by the market for the market. If I could wave a magic wand, I'd tell the major banks in the US to get together and agree a common format themselves for templates for mortgages and for car loans and for credit cards, and actually all agree they're going to get the same data template, tell their borrowers what they're going to have, and they'll all be in the same position. And what you'll have is a market which is cleaner than it can be today. If everybody's got the same, what you actually have is a uniform portfolio of data and a uniform way of acting, which means that everybody's on the same boat, but everybody's hopefully in the same boat, which is not leaky and which has a captain that knows where they're going.
I'd be shocked if all the banks came together.
So would I. We're still trying to create a common format for blockchain, right? So it's maybe it's a long way away.
They don't even have the same handheld when you tap your card. They don't even have the same handheld from bank to bank. Well, this has been tremendously helpful.
So perhaps to conclude, are there any risks that we're not talking about, that we should be talking about?
I think we've just started talking about them, and that is the due diligence risks in portfolios as a result of the fact that, deals have been written probably a little bit in haste. And I think that people are looking at fraud risk and things like that. But in reality, the risk is probably on light due diligence and making that due diligence actually slightly further than people contemplated. For example, do you do a due diligence on the auditor of the business? Do you do due diligence on the solicitors that are actually involved in the completion process?
Mhm.
So I think that the risks that we haven't really contemplated so far, which are probably starting to think about, are who are the other related parties in every transaction? How can we actually look to eliminate, or mitigate those risks to the maximum extent possible?
Yeah, I remember having a conversation several years ago with a client who was telling me that, yeah, due diligence was getting faster and faster and faster.
Correct.
Now we're seeing the risks associated with that. And so some of the deals may take a little bit longer.
Yeah,
But
and be a bit more expensive for it to
yeah.
put in place. I mean, I remember when I was back in HSBC, we didn't do a deal unless we did an on-site due diligence.
Mm.
We did some funding transactions for some home shopping businesses. We used to go to their offices and sit in on the calls and listen to the call handlers doing the calls to get a flavour for how those conversations, those collections processes work. Those things probably don't happen anymore. So maybe maybe we need to rinse and repeat and go back to that.
Some of the stuff we used to do in the old days was actually pretty good.
It was great first of all, because in organizations where you actually sit behind a desk and you're actually doing transactions from behind a computer, you lose the human touch.
Yeah.
And I think that human touch gives you a great insight into businesses and the people that are running them and the personality of a business and how it is. We used to call it in the old banking speak kicking the tires.
Yeah.
And I think maybe that's on its way back. And as far as I'm concerned, it's a good thing. That's actually the fun part, because meeting people and understanding what they do means you can provide more value. And that's great. If you can help people, it's always positive. And you go home at night feeling you've achieved something.
You're taking me back to my days as a junior auditor when the best part was the stock takes.
Yep, absolutely. I remember doing a due diligence of a whiskey manufacturer once. That was by far the best due diligence I've ever done in my life.
Outside of data, this is still a people business.
Yeah,
Absolutely.
absolutely.
And these connections, I mean, just sitting here speaking to you, I've learned more about data, the industry, EDW, your cufflinks, than I could have on a Zoom call.
Yeah.
Nigel, thank you very much for agreeing to be on the Alter Domus podcast. Sara, thanks for joining me again. And we'll see you next time on the Alter Domus podcast.